Matthew Naylor from the Bank of England. Here is the mouse, so you can point out, and then I'll move this so that it's...
I'll set my timer as well.
Is it all right, the mouse? Yeah. Okay.
Okay, wonderful. So firstly, thanks again to the organisers for giving us the opportunity to present this paper. Titled Useful, Usable and Used, Buffer Usability During the COVID-19 Crisis. I'm Matthew Naylor, I work at the Bank of England. I'm also studying for a PhD at the University of Oxford, and this is joint work with colleagues Akriti, Martha and Annie Rajan at the Bank of England, and the usual disclaimer applies. One thing to note is that Diana, I also thank you for discussing our paper in a bit. Diana has seen my two co-authors present this paper, so maybe she can give us notes on who presented it best as well. Okay, so in the wake of the financial crisis, the sweeping package of macro-prudential reforms that were introduced by Basel III had an important component, which was the introduction of regulatory capital buffers. And the idea of these regulatory capital buffers is that they require banks to hold levels of capital above minimum requirements, which I show in turquoise here this is the UK capital stacks on risk-weighted and leverage frameworks. And the buffer capital is meant to be satisfied above minimum requirements and above MREL in orange. And we've highlighted these sections. And the idea of these buffers is that they're meant to be useful for increasing sort of bank resilience during stress, but crucially, they're also meant to be usable, and they're meant to allow banks to dip into these buffers in order to sustain lending and maintain credit provision to the economy during times of stress, i.e. they're meant to dampen possible credit crunches or pro-cyclical credit dynamics. Now, while all of these regulatory buffers are meant to be usable, some of them are also explicitly releasable, i.e. the counter-cyclical capital buffer, or the CCYB, as it's known. And the idea is that there is no regulatory consequence for dipping into that releasable buffer once it's been released. So the COVID-19 shock was the first sort of major test of these Basel III implemented regulatory capital buffers. And in the face of an exogenous shock to the financial sector with heightened uncertainty and risk of unexpected loan losses, we broadly saw, as Chair Powell said an hour ago, we broadly saw that the resilience of the financial sector remained pretty solid. However, a big question was whether the counter-cyclical objectives of the Basel III regulatory reforms were going to be satisfied. And a key question was whether these capital buffers would be used during stress. And the reason why this was such a key question was twofold. Firstly, if I can move the mouse. Firstly, anecdotally, prior to the onset of the crisis, regulatory and supervisory discussions with banks indicated potential reluctance, potential fear of market stigma from dipping into these regulatory buffers, supervisory reactions, or distribution restriction action. And secondly, more broadly, while evidence on tightening macroprudential policies was pretty extensive, the evidence on loosening is slightly more limited. And there have been far fewer episodes of loosening prudential policies. And in particular, this was the first test of the Basel III tools. So essentially in this paper, we try to answer two research questions. Firstly, did buffer usability frictions impact UK banks' capital, lending and risk-taking behaviour through the crisis? And secondly, are there benefits to having releasable buffers during stress? And the way in which we answer these questions is we adopt fairly similar approaches and use the same data sources in analysing changes in and UK banks' capital and lending profiles in order to answer questions on buffer usability based on their pre-pandemic surplus above regulatory capital buffers, splitting banks into low and high surplus banks, and for insights on releasability, or the effectiveness of releasing capital we focus on the UK CCYB cut at the onset of COVID, and specifically we make use of the fact that that UK CCYB cut fed through into capital relief to different extents for different banks. So some banks received greater capital relief from the cut in the CCYB, and we make use of that heterogeneity. And for spoilers, what we find is the following. Firstly, buffer usability frictions impacted bank behavior during COVID-19. While all UK banks increased capital ratios, the relative increase was larger for low surplus banks. And as a result of that, or in order to defend their capital surpluses, low surplus banks maintained tighter lending terms and reduced their risk-taking capacity relative to peers. In potentially more positive news, releasing buffers can help, and they can help dampen these unintended consequences of buffer usability frictions, and they may be a necessary precondition for their usability. Specifically, banks that receive greater capital relief from the CCYB cut maintain more stable capital ratios, and they use that extra capital space to loosen lending terms or provide more credit to the economy and take on more risk. In terms of the general literature in which this belongs, within the sort of effectiveness of, or literature looking at the effectiveness of macroprudential policies across the various tools, we focus on specifically capital requirements, and in relation to the various objectives, so across sort of between financial system resilience and sort of objectives of smoothing the credit cycle, we focus on the latter. And so in relation to the effect of capital requirements on credit cycle smoothing, there are sort of three strands of the literature that we can hone in on. Firstly is pre-Basel, where evidence of tightening requirements restricted credit supply and could soften pro-cyclical credit dynamics. But despite evidence on loosening being more limited, the suggestion from some of the literature is that there are these asymmetric responses, that loosening is less effective than tightening. The second strand is post-Basel III reforms, but pre-COVID. During this episode of tightening, again, capital requirements have been found to restrict lending in the short run. And now we get to the literature that we contribute to, post-Basel III reforms and post-COVID, i.e. the first episode of loosening for Basel III reforms. And there has been work looking at similar questions. So on usability, there's work in the US and the EU finding similar results to ours, that there are usability frictions that impact bank behavior, and on releasability, similar results to ours again, which I guess is encouraging, and I'm going to spend the next 30 minutes or so trying to convince you that our paper is of particular value. So in terms of the contributions, well, firstly, we provide evidence on the effectiveness of loosening macroprudential tools, and in particular, this is the first test for Basel III capital regulation. And secondly, we focus on the UK, which allows us to do two things. Firstly, we're able to really precisely measure banks' surpluses above their buffer requirements. And we count for a whole host of other things that capital may be used for, to identify that using confidential regulatory data. The second is that we have, if the clicker works, the second is that we have within the UK an instance of a cut to a positive CCYB. An explicit cut, which is quite rare. That hasn't happened in many countries. And then third, our third main contribution is the following. We have a fantastic loan level mortgage data set. We have a transaction level data on the universe of UK mortgages. And this allows us to zoom into a key segment of the household credit market that wasn't directly impacted by government guarantees in the same way that corporate lending was. But it also gives us extremely granular data on risk and or borrower risk characteristics, allowing us to strip out loan demand and borrower risk to really identify credit supply risk. Okay, so onto are regulatory buffers usable? So our approach, which I've touched upon, is we look at the pre-pandemic distance to regulatory buffers as an indication of the likelihood of a bank having to draw down on their buffers once an anticipated shock hits. And there's a few different ways in which you can calculate capital surpluses. The way we do it is we focus on effective CET1 surpluses. What do I mean by effective? Well, we take into account the CET1 that's used to meet other lower qualities of capital and also other requirements, so leverage and EVRA. And I'll show you in a minute why this is a major contribution of our work. So using quarterly confidential regulatory data on 159 UK banks, we're able to group banks into low surplus and high surplus banks. The low surplus banks are those with, we categorize or define as those with a 2% effective surplus above their capital buffer requirements or less, and high surplus banks have a greater than 2% surplus. We use different definitions for robustness, including sort of bottom quartile versus the rest, or continuous measures, and our results are pretty robust, very robust to all specifications. We drop the top quartile of our distribution because we find there's an extremely long tail, so for comparability reasons. So I mentioned that the effective surplus measure is a key contribution. This is why. Here we have the distribution of effective surplus the distribution of CET1 surpluses above buffer requirements for the effective measure, which is our contribution in red, and the simple measure in blue. We see that the effective measure is a leftward shift to the simple surplus and is tighter, indicating that the simple surplus routinely overestimates the degree of headroom that a bank has to their buffer requirements. So, onto some trends. So here we have the unconditional evolution of surplus for low surplus banks in red and high surplus banks in green on the left-hand side in levels. We see that the evolution prior to the onset of COVID in 2020 Q1, their trends were relatively similar, and then post, also quite similar. Both groups of banks, on average, increased their capital surplus by 1.5 percentage points over 2020. But then on the right-hand side, we index this to their pre-COVID value, and we see that in relative space, or in relative terms, this represents a greater relative increase for low surplus banks compared to high surplus banks. So in relative terms, they increased their surpluses by 100%. This is all unconditional, and so we test this in a different diff regression specification. So here we have as our dependent variable either capital surplus or log capital surplus for the growth rate of surplus, and we test the association with our independent variable of interest, which is this interaction term, low surplus times post-COVID. A bank is low surplus if a bank is low surplus, then it receives a dummy of 1. If it's high surplus, 0, and 1 for post-COVID. And then we use our confidential regulatory data set to be able to account for or strip out, condition on, a whole host of bank balance sheet variables. So to capture sort of banks' business models, profitability, liquidity, provisioning, etc. And then we have bank and quarterly time fixed effects. And so the interpretation is, well, if the beta 1 coefficient is positive, we see that low surplus banks defended their capital surpluses by more post-COVID than peers. And this is exactly what we see in relative space. So while in column 1, there's no difference in levels, as we saw in the unconditional trends, in column 2, in relative terms, the increase was, or constituted, a greater relative defense of their capital surpluses. And so the question is, how did they defend their surpluses? Did they restrict lending in order to do so? So here's some data on pricing and product availability in the UK mortgage lending market. We see that there was a tightening of conditions in both. On the left-hand side in pricing, there was a particular increase in price for risky loans, so high LTV or LTI loans. And on the right-hand side, there was a decrease in product availability across the board, but in particular, again, for the riskier loans, for the high LTV loans. And so the question is, were there fundamental differences between low surplus and high surplus banks in the degree to which they sustain credit? And so we test this now using our, as I mentioned before, wonderful loan level data set on the universe of mortgages. So here we test the interest rate to capture price and loan value to capture quantity. On the left-hand side, for each individual I in postcode L from bank B, receiving a loan from bank B at time t. And now we have the same interaction term of interest, but now we're able to control, and the same or similar lagged bank controls, but now we're able to control for loan and borrower risk at the individual level. And we're also able to account for postcode time fixed effects and postcode bank fixed effects, which allows us to strip out sort of variations in loan demand at the postcode level and across time, and also account for differences in bank presence. And by postcode, we mean 3-digit postcodes in the UK, which are similar to sort of US zip codes. So it's very granular. There's only 23,000 people within each postcode on average. And the interpretation of a positive gamma 1 for interest rates is that low surplus banks increased prices relative to high surplus banks and reduced loan values. And this is what we see. We see that low surplus banks maintained higher interest rates post-COVID by 3.7% and maintained lower loan values after the onset of the pandemic. And taken together, that points to buffer usability frictions. Low surplus banks defended their capital surpluses by more, and they restricted lending as a result. So on the CCYB, on the releasable buffers, we use a similar definition. We make use of the fact that although the CCYB cut was the same for all banks, it fed through into a reduction in capital requirements to different degrees. And we refer to a high pass-through rate bank as a bank that received greater capital relief and a low pass-through rate bank who received higher, so less than 50%, greater than 50%. And this depends on the degree to which credit exposures are based in the UK. That's how it works. And again, we for robustness, we check this against the definitions and it holds. So here we see really interesting dynamics. We see that banks that received greater capital relief maintained more stable capital surpluses. And this strips out the mechanical reduction in the CCYBs. This is just behavioral. Whilst low pass-through rate banks defended capital surpluses. So then the question is, did they use this extra space in capital surpluses to maintain greater lending? Well, firstly, we see that this is statistically significant in our regressions. They maintained lower CET1 surpluses. And then we ask, did they use the space to sustain lending? And the answer is yes. High pass-through rate banks maintained lower interest rates by 3.7% and higher loan value. So being a high pass-through rate bank partially offsets the impact of buffer usability frictions on deleveraging. Then finally, we look at risk-taking. And we define risk-taking in a few different ways, which I'll get onto in a moment, but essentially we augment our baseline specification to have a triple interaction. So now we look at the impact of being a low surplus bank post-COVID relative to a high surplus bank on the degree or on the pricing or quantities that you offer on a loan that's considered risky versus not risky. So if you increase interest rates on a risky loan relative to a non-risky loan compared to high surplus banks, that's evidence of curtailing of risk. And so we measure this in two ways. The first is COVID specific. So we look at, or we define high case rate areas at the regional level as reflecting high risk borrowers. And to motivate this, there's a few high case rates are correlated with restrictions, pandemic restrictions, and have also been identified as also being associated with high default probabilities. And this chart is quite neat. We show the change in volume of mortgages by low surplus banks on the left-hand side and high surplus banks on the right-hand side in high case rate areas. So in the riskiest areas, how did volume of mortgages change? And we see on the left-hand side, low surplus banks decreased lending by more. It's darker red. So then we put this to the test in our regressions, and we see that in high case rate areas, low surplus banks reduced loan values. The pricing wasn't statistically different, and the high CCYB pass-through rate banks reduced prices and increased loan values. So again, they're acting in opposite directions. There's a buffer usability friction, releasability is helping. We also define risky loan more conventionally by sort of high LTV, high LTI, and zooming in on first-time buyers. And here we see again the same thing. Low surplus banks increased prices, reduced quantities to these risky loans, and high CCYB banks did the opposite. Again, buffer usability frictions, releasability, alleviating those frictions. So in terms of our conclusions, this is what we said before. All UK banks increased capital ratios, but this relative increase was greater for low surplus banks. Low surplus banks, as a result, maintained tighter lending terms and exhibited higher risk aversion, whereas in contrast, releasability may be a necessary precondition for usability. banks that receive greater capital relief from the CCYB cut were able to maintain more stable capital ratios, provide greater credit, and take on more risk. Policy implications are fairly clear, but they essentially highlight potential unintended consequences of the Basel III reforms. And this is particularly striking in the face of the widespread financial, fiscal support, monetary support that was provided during the crisis. But in better news, or in more positive news, they also support releasability of regulatory capitals as a means of dampening these unintended consequences. And I'll leave you with that. Thank you very much.
Okay, thank you very much. Okay, so here we are. Okay, so the discussion is going to be Diana Bonfim, and let me pass the mouse. Sorry, I moved this. Okay, there you are, 10 minutes.
So thank you so much for the invitation to discuss this paper. These are going to be my views, not those of the Bank of Portugal, nor the ECB. And so the paper plays with these three words: usable, used, and useful. So the questions are, I mean, if capital buffers introduced in Basel III are usable. Second, if they were actually used, and I think it's a combination of the two that actually makes them useful. So let's first think about the usable part. So Basel III introduced these different capital ratios that Matthew explained to us in the beginning and are familiar to most, to mitigate something that was well identified in Basel II by Rafa and Javier in the room and other authors, that showed that Basel II could be highly procyclical, and regulation could even exacerbate the natural procyclical behavior of banks. But the question that was always around these new buffers introduced by Basel III was, to what extent are they usable? Okay, and there are several good reasons to believe they might not be usable, especially if we think that during a crisis, during a recession, banks might want to hold on to the capital ratios that they have. And second, I mean, we also want to understand if banks actually use these. And so COVID is the first, as Matthew told us, was perhaps the first opportunity worldwide to see, to understand empirically how banks were making use of these buffers, okay? And this is especially true for when you think about the CCYB, the countercyclical capital buffer, which is precisely designed to be released in situations such as the one we experienced in early 2020, okay? With the goal of avoiding a credit crunch and making sure that banks can draw down explicitly on these buffers to be able to continue to lend to a distressed economy. And so I think the idea that the authors want to convey with this paper is that for buffers to be useful, they need to be usable and they need to be used or released. And so what you do in the paper is to use COVID-19 as an episode to test the use and the release of capital buffers in the UK. And so there's two main questions in the paper. First, did banks make use of the capital buffers, or did they try to just remain well capitalized or even to further increase their capital ratios? And second, did banks make use of the capital buffers to actually lend during a crisis and support the economy and avoid this credit crunch scenario? And so the main findings are that the banks that had less capital surplus before the pandemic, they actually made an effort to improve their capital ratios. So in a way, they acted pro-cyclically. They offered loans with higher loan rates, they offered lower loan amounts, and they offered tighter terms in riskier lending, okay? On a more positive note, banks that had the greater capital relief coming from the release of the countercyclical capital buffer, well, in this case, at least the banks did not act pro-cyclically. Maybe they didn't act countercyclical either, but at least they didn't reinforce the cycle. So I think the paper really is a very thorough analysis of everything that happened in the UK. I mean, the authors really try to make the best use possible of the amazing data that they have and look into this through different angles, and they try to be very careful with empirical strategy, and I think the paper offers really very important policy implications. So overall, I have an incredibly positive view of the paper, but I have 3 questions that I would like to discuss. So first, about how the banks adjusted overall. Second, about empirical design and the specificities of the setting related to the pandemic. And third, on more general terms, about the role of countercyclical regulation. Okay, so about the bank's adjustment. Okay, this is a low-quality picture of how a simple balance sheet of a bank looks like. And in the paper, the authors focus mainly on 2 items. Okay, they focus here on the role of bank equity and how banks adjust equity in the aftermath of the pandemic, depending on how well capitalized they were, and also on the pass-through of the release of the countercyclical buffer. And they also look here into this mortgage part. Okay, so they have amazing and quite unique data on mortgages, and so the first part of the paper is anchored on equity, and the second one on the mortgages. But of course, there's much more things going on, right? And of course, I would be curious to also understand what were the other margins of adjustment of the banks during this period. Of course, we cannot do this in such a causal, well-identified setting, but at least to have some descriptive overview on what happened to corporate loans, to security holdings, to the funding structure of the banks. Of course, we have monetary policy at work here. We have many other shocks happening at the same time. And I think it would be interesting to at least provide some broad description of this. And this is especially for one reason. So my question here is, how important are the mortgages in shaping the adjustment? So mortgages are perhaps one of the assets that the banks have with lower risk weights. And so if the banks are indeed, as shown in the paper, trying to improve or at least stabilize their capital ratios, well, mortgages are not the more efficient way to do that. Okay, these are already asset categories with very low risk weights. And so I wonder if this means that the results displayed here in the paper are somehow a lower bound for the effects, because maybe we could expect that the adjustments for corporate loans, for instance, where risk weights are much higher, could be much sharper. And of course, this also interacts with the question about, how other support measures affect the banks. So there's some effort in the paper to deal with this, but I think it could also help us to think about all these interactions. So on my second set of comments about COVID and empirical design, of course, an easy question to ask is if COVID is the ideal setting to test the role of buffers. I think we will never have an ideal setting to test it, so I think this is a very useful exercise to do. That said, I think one challenge that the authors acknowledge is that it's not easy to control for mortgage demand. So in the corporate loan literature, this type of analysis is typically done by looking into a firm that borrows from at least 2 banks at the same time, and we're going to compare how what the 2 banks are offering to the same firm is varying. Of course, no one gets 2 mortgages at the same time from 2 different banks. And so here what the authors try to do is, what they claim in the paper is they say we're going to test whether a new loan issued to a borrower I in local area L by Bank B in quarter T was priced differently after the onset of the pandemic by 2 different banks, depending on their surplus of capital and depending on the pass-through of CCYB. I think this deserves a more thorough explanation in the paper. Okay, I think this is not entirely clear. That there's also controls for borrower characteristics here. They're also changing, and their importance is also changing during the pandemic. So I think that being clearer and more detailed about what is going on here and how is this effect identified, I think it would be very important. Still on this item, I think that there's a final part in the paper that Matthew showed us where the authors look into the heterogeneity across the UK in the number of cases and local restrictions. I think it would be interesting to see how important these really were in terms of lending decisions. I think showing some supporting evidence would be interesting, because the effect is captured mostly by these triple interactions. So it's really not easy to understand what are the mechanisms at work. So I think here in the slides it was, you focused more on the results where there's only one of the buffers working at each time, and those are also in the paper. But then most of the tables in the paper are using the two buffers at the same time. And I think there's for sure correlation issues that might somehow cloud the interpretation of the results. So I think it would be interesting to look into this as well. Very minor point. I mean, why is the reference period 2009 Q1? I think it would be much more to the point to use the first pandemic quarter. And so let me just conclude with the last comment, which is more policy oriented in a way. So Basel II was recognized as being perhaps too pro-cyclical, and I think we have to talk about counter-cyclical regulation. I mean, I think a lot of what we know and think about counter-cyclical regulation actually was designed here in this building when dynamic provisions were set up a few decades ago. And the results of the paper suggest that, at best, the buffers can mitigate pro-cyclicality, not really act counter-cyclically. And I think this is very valuable, and I think the paper could also gain from providing more descriptive insights. For instance, I could not understand if any bank actually used the buffers, if they really went on. I believe not, but it would be interesting to show and discuss that. And then on a policy, I think, I mean, there's a few interesting aspects to explore. For instance, I mean, as far as I know, the Bank of England had a strategy of keeping the CCYB structurally above zero permanently. I hope I'm not wrong on that. But I wonder if the results show that this is somehow important. And one thing that you could perhaps do would be to look into internationally active banks that are not subject to this buffer in the same way, and see if there's something coming out of this, because I think this would be a really important policy implication for the design of the buffers. Another thing I found very interesting that you mentioned somewhere in a footnote is that the Bank of England, at the beginning of the pandemic, carried out stress tests showing the banks that they would be better off if they continued to lend to the economy instead of just cutting lending overall. And I wonder if this pedagogical approach somehow encouraged the banks to lend. And so by looking into banks that were exposed or not to these stress tests, I think we could also learn a lot. I think we could also learn from this paper about synergies and conflicts between micro and macroprudential policies. And with this, I will conclude and just recommend you to read this paper, both from an academic perspective and a policy perspective. I think there's a lot of content here, and I wish the best of luck to the authors to publish this paper well. Thank you.
Okay, thank you, Diana. Let's, Matthew, quick response to the comments, and then we'll open the floor.
So firstly, thank you very much. That's extremely helpful comments. So just coming back on a few things. So you mentioned that we're focusing on mortgage lending data, not corporate data. The truth is that we'd love to also look at corporate, but we don't in the UK have the same transaction level data set for corporate as we do for mortgage. You then mentioned that mortgage lending typically is associated with lower risk weights, and so isn't as efficient for banks to sort of change behavior on if they're trying to increase their or defend their capital, but which, as you say, I think probably makes our results even more striking. If we're finding this result for mortgage lending, then yes, the suggestion is that it's potentially or likely to be even stronger for corporate. So it might well be a lower bound, which I think speaks to how striking our results are, despite, again, all of the sort of government and financial fiscal support. But I take that point. People should good. We don't. Then there was a question about controlling the loan demand and borrower risk characteristics, etc. So yeah, I take your point that we maybe need to explain this a bit better in the paper. In fact, when I was editing these slides, I kind of had the same thought. We think that our identification strategy is pretty robust because of this loan level data. So we're able to have postcode time fixed effects, which essentially strip out unobserved changes at the postcode level. So per 23,000 people on average over time. And we're able to couple that with individual level characteristics for borrowers. So we have data on LTV, LTI, whether they had income verification, whether they're self-employed, first-time buyers, etc. And so essentially we're able to compare the change pre to post-COVID for low surplus versus high surplus banks on essentially the same borrower, stripping out all of these effects. But you're right, we need to maybe explain that a bit better. Then there were some other points about having low surplus and so the usable and releasable in the same regressions. We do try them in separate regressions. We get the same results. We have them in the same regression just to be able to demonstrate them a bit more succinctly, but it's a good point. Did any banks actually use buffers? No. That's the simple answer. No, they didn't. And that's why we focus on the surplus above their buffer requirements, because we don't, as a proxy for frictions. We can't look at, because they didn't. Yeah, that's a good point. Thank you so much.
Okay, so let's open the floor. Let's start now with Anatoly at the back.
Matthew, very interesting presentation.
Speak up.
So, the question, so in the euro area, supervisory authorities also responded to the COVID shock by encouraging banks to use the capital conservation buffer, which is a more, not formally releasable, more structural buffer, and they kind of try to reassure banks that if they were to use that buffer, supervisory interventions would have not been triggered immediately. So my question is whether or not you can use the similar approach of heterogeneous pass-through of capital conservation buffer release, quote unquote, to ask yourselves the same questions, and was that useful at all, and more useful than the release of properly released capital buffer? Thank you.
Javier?
Okay, thank you for the presentation. I see your paper perhaps with a little bit of distance as a paper on maybe, or with the underlying question of why banks have voluntary buffers, what they want the voluntary buffers for. And I can imagine two stories. In one story, banks want the buffers to better absorb unexpected losses, no, above and beyond what the requirements will give them in terms of loss absorption. Now, in that type of case, I would expect the banks with the high buffers to be the ones that don't want to use the buffers in bad times, in the sense of giving more lending out of them, because they were holding the buffers as a precaution against potentially larger unexpected losses. In another view of the world, which is maybe more consistent with things that I have done with Rafa, those buffers are there to protect your lending opportunity. So I would expect the banks with the higher voluntary buffers ex ante to be those who have better lending opportunities to protect, higher on average in terms of profitability in bad times. The banks with the low buffers will be the ones that don't expect to have very profitable opportunities in bad times, and they don't want to protect their lending in bad times. Then, if you find that when the bad times materialize, the banks with the low buffers decide to expand their lending less, this is perfectly consistent with the second view, and less perfectly consistent with the first view, right? So I will tend to read the results more in this sense, that in sense of what is usable versus use, and I'm not sure I saw the regulatory natural experiment here, because at the same time there was release of a part of the buffers. There was also dividend restrictions, which make very hard to interpret what is going on with the voluntary buffers after COVID, because these are not voluntary anymore. The voluntary buffers after the event are the result of the imposition of constraints on payouts. So the banks that don't want to have buffers probably wanted to have high dividends, and when the dividends is cut, basically keep the buffer high for distributing after the pandemic. Sorry, because I'm not sure this is a question. This is sort of giving background to your results. Thank you.
Okay. Is there any other question? Okay, Matthew, the floor is yours.
So on the euro area equivalent, so there's a paper by Kouaye who tried to, and co-authors who tried to essentially ask the same question on impact of releasability based on that policy in the euro. They don't have a positive CCYB, but that's exactly how they try to relieve capital. And they find pretty similar results to ours in that had a positive effect on banks' capital behavior and also their lending. In terms of the implications for us, I mean, in the UK or other jurisdictions on sort of capital conservation, I think the Financial Policy Committee at the onset of COVID released a statement trying to encourage banks to dip into their regulatory buffers. So that includes the capital conservation. They didn't distinguish between capital conservation and systemic risk, but they released a communication to try to encourage that behavior. And yet, no one did, and we're trying to identify whether they did. They didn't because of potential frictions. So in terms of what we can take away from the euro area experience is that it could have an effect if there's no CCYB, but it didn't in the UK context. Javier, I think you make very good points. I think in terms of the interesting question is pre-pandemic, what leads to banks having the surpluses that they do, and so i.e. what's their risk aversion or what's their ideal management buffer over buffer requirements, and why would they have it? Is it because they think that the buffer requirements don't actually give them enough capital to be able to absorb the shock, or is it for other reasons? Is it because in the event of a shock, do they not believe that they would be able to raise capital, which is also different for different types of banks? Essentially, we try to strip out. We don't try to draw insights onto that. We try to strip it all out where possible through bank time fixed effects or bank level controls to try to really to try to strip out any variation that isn't just fundamentally where you started before the pandemic in terms of your capital surpluses. So we don't draw insights into what drives that initial decision, but we try to strip out to the extent that that's associated with other bank characteristics or observed variables through the bank time fixed effects. We try to strip out. So I don't have necessarily a response for you. I know that there's other work that tries to identify where the buffer usability frictions may be coming in specifically. My co-author Arkwiti and Annie have a separate paper which look into that, and they seem to find that it is the distribution restrictions that generate this friction. So insofar as I can lean on their research to give you some sort of indication as to what might be causing it. Yeah. But in our paper we just try to identify an issue without necessarily generating or looking into what's driving that specifically.
Okay, so thank you, Matthew.